US inflation cools in May and consumer spending rises moderately. Welcome to Market Insight. I'm Paul Barber. The Commerce Department has released data showing that personal consumption expenditures, or PCE, price index remained flat in May after rising 0.3% in the previous month. In the 12 months through May, the index increased 2.6% after advancing 2.7% in April. That was in line with what economists polled by Reuters had forecast. The report also showed that consumer spending increased 0.2% last month. Well, joining me now to talk about all of that is Gregory Daco, Chief Economist at EY-Parthenon. Welcome back to the programme, Gregory. Thanks for joining us. We'll get to that PCE data in just a moment, but first I have to ask you about what everyone's talking about, that presidential election debate last night, and President Biden's halting performance against Donald Trump. Is it fair to say that this might have loaded a whole lot more uncertainty onto the economy, bearing in mind, of course, the recent quarterly GDP estimates?
I think we are at an inflection point when it comes to the overall economy. We have started to see some slowdown in terms of the labor market, in terms of consumer spending, more prudence, not a retrenchment, but more uncertainty as to the trajectory of the economy. And I think that the election uncertainty that we'll see over the coming months is likely to feed into that, delay perhaps some investment decisions and perhaps some consumer spending decisions as we navigate through this volatile period. So certainly we're going to have one more layer of uncertainty as we navigate the second half of this year.
So we've just seen the flat reading in the personal consumption expenditures, or PCE, price index last month. So inflation is cooling. Does this mean that monetary policy is working? And what could that mean for the Fed cutting rates this calendar year?
I think we have confirmation again that the first quarter was essentially a hot quarter when it comes to inflation, but that the disinflation momentum remains firmly in place. If you look at the most recent May data, you saw that on a month-over-month basis, inflation dynamics are soft. If you look at the 3-month, 6-month, or even annual pace of inflation, they're all moving in the same direction, which is lower. So disinflation fundamentals remain firmly in place, especially with consumers exercising a little bit more prudence and being more price sensitive, and businesses noticing that and being more careful with their markups. The underlying inflation dynamics are still pointing towards inflation moving towards the Fed's target towards the back end of this year. We're probably going to be around 2.5% inflation, but in 2025, we'll be much closer to the Fed's target. That will open the door for further easing from the Fed. That starts, we think, in September and has another rate cut in December, and then gradually eases monetary policy over the course of 2025.
Okay, well, let's talk a little bit more about consumer spending, which of course accounts for more than 2/3 of US economic activity. So that increased 0.2% last month, but it has been weak, hasn't it? Are there signs that consumers really are still under stress?
Well, consumers are being more prudent with their outlays. They're not retrenching in any particular way, but they're being more judicious as to how much they buy and what they spend their dollars on. And that's in an environment where income growth has cooled. It's still positive. We're still seeing income on the rise, but it's slowed in terms of the pace because labor market momentum has slowed and because wage growth has slowed. The combination of the two are the two key drivers of consumer spending activity. So what we saw in May is actually quite encouraging. We're seeing a moderation in the pace of consumer spending, still moving forward, but doing so at a cooler pace, which is good in terms of the future inflation dynamics and can actually help us settle at a level, a pace of growth that is more sustainable, around 2%, with inflation moving back towards that 2% target and the Fed being allowed to gradually recalibrate monetary policy.
So wage growth has slowed. What do you see as the main risks in the labour market?
I think the main risk in the labor market is that we did not see a gentle easing. What we've seen so far is evidence of flows in the labor market gradually easing. The hiring rate has fallen back to a 2018 low. The quits rate has also fallen back. The jobs openings rate has also fallen back quite rapidly. And we've seen hours worked fall back down. We've seen a gentle creep up in the initial claims for unemployment and the unemployment rate. Those are right now still fairly moderate. It just points to a moderation in the pace of employment growth. The major risk is that we start to see a more pronounced pullback in employment growth that would curtail income and in turn lead to a pullback in consumer spending.
Gregory, we'll leave it there. Thank you so much for your time. Gregory Daco, Chief Economist at EY-Parthenon. And that is your Market Insight. You can watch more videos on Reuters.com.